You've been told your credit score is a measure of trust, a reflection of how responsible you are with money. Pay on time. Your score goes up. Miss a payment, it drops. Simple, right? Except it's not. Because your credit score isn't really about trust. It's about profit. It's a system built not to protect you, but to predict how much money can be made from you. Before we start, drop your state or FICO range in the comments. Let's see how credit scores really look across America. Who's fighting to get from 580 to 650? Who's stuck in the 700s and still feels trapped? Because once you understand how this game works, you'll never look at that number the same way again. This is educational content, not legal or financial advice. Credit reporting laws and practices, including FCRA regulations, dispute procedures, credit-based insurance scoring, and employer credit checks, vary significantly by state and industry. Always verify your specific rights and obligations before taking action. Let's start with the illusion. The illusion of fairness. The story you've been sold about what your credit score actually means and where it comes from. The story goes like this. Credit scores are neutral, objective, mathematical, a pure reflection of your risk to lenders based on data and statistics. The higher your score, the less likely you are to default, so you get rewarded with lower interest rates. The lower your score, the riskier you are, so you pay more. It's fair, it's logical, it's just data doing what data does. An algorithm measuring risk. Nothing personal, nothing biased, just math. But here's the truth that nobody explains when you're first learning about credit, when you're opening your first card or applying for your first loan. Your credit score isn't your data, it's a product. And in many ways, you are the product. Credit bureaus, Experian, Equifax, and TransUnion don't exist primarily to serve consumers. They're not nonprofits looking out for your best interests. They're not government agencies ensuring fairness. They're private, for-profit companies. And they exist to serve lenders. They collect your financial information, your payment history, your debt levels, your credit limits, your account ages, every detail of how you interact with credit over time. Then they package that information, analyze it using proprietary algorithms, create scores from it, and sell access to those scores back to the banks, credit card companies, auto lenders, mortgage companies, and other businesses who profit from lending to you or doing business with you. And then, and this is the part that should really make you pause and think, they often make you pay again just to see the score they built about you using your own data. You pay to access information about yourself that they collected from your own financial behavior without your active participation. You don't control it. You don't own it. You can't opt out of it. You just live inside it. You navigate a financial system where this number, created by private companies using your data, determines your access to housing, to transportation, to loans. Some employers in certain industries may request your credit report, not your score, but your full report, with your written consent as allowed by the Fair Credit Reporting Act. Credit-based insurance scoring for auto and home insurance is permitted in many states, though not all, and is regulated at the state level. That's not empowerment. That's not a tool built for you. That's a product ecosystem where you're both the raw material and the customer at the same time. But let's zoom out. Here's what most people don't realize about how this system actually works at the structural level, and this is where it gets really interesting. There's not one credit score. There are dozens, potentially hundreds depending on how you count variations and versions. FICO alone, the most commonly used scoring model, the one most lenders rely on, has over 60 different versions. 60 different ways to calculate your credit worthiness depending on what you're applying for. There are different FICO scoring models specifically designed for auto loans, different models for mortgages, different models for credit cards, different models for personal loans. Some industries use models that weigh certain factors more heavily than others. There's even scoring models used in insurance decisions in states where credit-based insurance scoring is permitted. You might have a 720 on FICO 8, which is the version most credit card companies use when you apply for a card. You might have a 680 on FICO Auto Score 9, which some auto lenders prefer when you're financing a car. You might have a 640 on Vantage Score 3.0, which is the competing scoring model that the three credit bureaus created themselves to compete with FICO. And here's the key part that most people never realize. Lenders get to pick which score they use. They choose the model that serves their business interests best. They can look at multiple scores and use the one that helps them make the decision they want to make or justifies the rate they want to charge you. The score you see when you check Credit Karma or your bank's free credit monitoring service? That might not be, and often isn't, the same score the lender sees when you apply for a loan. Credit Karma uses Vantage Score. Your bank might show you FICO 8, but the auto lender might pull FICO Auto Score 5, and they're all different numbers based on the same underlying data. So when people talk about your credit score as if it's one fixed, objective number that everyone agrees on, that's already a fundamental simplification that obscures how the system actually works. And here's the deeper truth about what these scores are really measuring. The credit score isn't just about predicting whether you'll pay lenders back. That's part of it, sure. But it's also about predicting how long you'll stay profitable while you do. How much revenue you'll generate, how much interest you'll pay, how long you'll remain a customer. Think about it from a pure business perspective, from a lender's point of view. If you have a perfect 850 score, you're the most creditworthy person mathematically possible according to the model. You get the lowest interest rates available. You're safe, sure. You're reliable. The data says you're extremely unlikely to default, but you're also likely to pay off your balances quickly. You probably have significant income and savings. You're probably not going to carry debt for years. You're low risk, but you're also often low revenue. You don't generate much profit in interest payments because you're not borrowing for long. If your score is terrible, 500, 520, 550, somewhere in that very low range, you're high risk according to the model. You might default. You might not pay at all. The lender might have to write off your debt as a loss and send you to collections, which costs them money and generates no profit. That's not good for business either. But if your score is in that middle zone, 620, 640, 660, 680, maybe low 700s, you're in what the industry sometimes internally calls the sweet spot for profitability. You're high enough to get approved for credit. Your score says you're probably going to make your payments consistently. You're not likely to default completely, but you're low enough that you can be charged 18%, 22%, 24%, sometimes 29% interest depending on the product. You're likely to carry balances for a while because you don't have unlimited income. You're likely to make minimum or near minimum payments for months or years because you're managing multiple obligations. And that's where the real revenue is generated in consumer lending. That's where the system is most profitable. Not with people who have perfect credit and pay everything off immediately and never carry balances. Not with people who have terrible credit and default and become losses. But with people in that middle zone who are stable enough to keep paying month after month, but stretched enough to keep borrowing and carrying balances. Not failing, not winning. Just consistently, predictably paying over long periods of time. Watch what happens next. This is where the psychology gets really deliberate. Credit scores are marketed and sold to consumers as empowerment. Take control of your financial future. Know your number. Improve your score and unlock better rates. Monitor your credit for free. It's positioned as a tool that helps you, a metric that works in your favor if you just understand it and optimize it correctly. But what credit scores actually sell in practice on a psychological level is anxiety. Constant low-level anxiety about a number that affects your entire financial life. Think about how it feels when you check your score. Think about the emotional response. That little three-digit number on a screen, somewhere between 300 and 850, determines your access to housing, to transportation, to loans, to credit cards. It affects how much you pay for insurance in states where credit-based insurance scoring is allowed. It affects whether a landlord will rent to you. It affects whether you can get a cell phone contract without a deposit. In certain industries, with your written permission, employers may review your credit report as part of their hiring process. You celebrate when it goes up 10 points, even though 10 points rarely changes anything material about your actual borrowing costs. You panic when it drops 20 points because you see that number go down and your brain immediately thinks, something is wrong, I'm losing ground, I need to fix this. You start obsessing over utilization ratios, making sure you're using less than 30% of your available credit, ideally less than 10%. You start worrying about hard inquiries from applying for credit. You start calculating the average age of your accounts and wondering if you should close cards you don't use or keep them open to maintain your history. You start timing your payments to make sure they post before your statement closes so your reported balance is as low as possible. You start chasing the score instead of chasing actual financial stability. You start optimizing for the metric instead of for your actual financial health. And the system knows this. The entire credit monitoring industry, the apps, the services, the alerts, the notifications telling you your score changed, or new activity detected, or you could improve your score by doing X. That's not primarily designed to help you make better financial decisions. That's designed to keep you engaged, to keep you checking, to keep you clicking, to keep you worried just enough that you stay active in the system and keep paying attention to the score. Because anxious consumers make predictable payments. People who are constantly monitoring their scores, constantly worried about drops, constantly trying to optimize and improve, those people stay engaged with credit. They don't abandon the system. They keep accounts open even if they don't need them. They keep using cards even if they'd be better off with cash. They keep participating, keep generating data, keep staying active in a system that profits from their participation. And predictable, consistent, anxious participation is what generates steady profits over time. Drop a yep in the comments if you've ever felt like your score was controlling you instead of the other way around. If you've ever made a financial decision primarily to protect your score rather than because it made sense for your actual situation. And here's the part no one talks about openly. Here's where the dependency gets built in at the structural level, where the system teaches you to need it forever. The system teaches you, explicitly and implicitly, that the only way to build credit is to use credit. Think about that circular logic for a second. You need credit history to get approved for credit. You need to borrow money and pay it back over time in order to prove you're trustworthy enough to borrow money in the future. You need to demonstrate that you can manage debt in order to access more debt. So even when you've paid off your cards, even when you've gotten completely out of debt, even when you're finally free from owing anyone anything, you're told by financial advice articles, by credit monitoring services, by conventional wisdom that you should keep a small balance or use the card every month for small purchases and pay it off to maintain your credit history and keep your score from dropping due to inactivity. You're told that having zero debt might actually hurt your score because you're not demonstrating active credit management, or because your accounts will eventually age off your report if you stop using them entirely. That's not financial advice that's truly in your best interest. That's conditioning. That's the system teaching you to stay dependent on it. That's the system saying, even when you don't need us, you still need us to maintain your access to us in the future. Because here's what's actually true when you separate myth from reality. Carrying debt doesn't build your credit score. Making debt payments doesn't build your score. What builds your score is responsible payment history, paying your bills on time consistently over long periods. Low utilization relative to your available limits. Long account history showing stability, a mix of different types of credit over time. Those things build credit. But lenders and the credit industry have a vested interest in you believing that carrying a balance and making payments over time is the same thing as having a good payment history. They benefit when those concepts blur together in your mind. They benefit when you think, I need to use credit to build credit, rather than, I need to manage credit responsibly when I use it. They want you to stay active in their systems. They want you to keep swiping cards. They want you to feel like you need them, just a little, forever, even after you're financially stable. Even after you could theoretically live without credit entirely and pay cash for everything. The entire structure is built around this paradox. You must stay in the game to keep your score viable, and you must keep your score viable to stay in the game and have access to credit when you might need it. That's not empowerment. That's engineered dependence dressed up as financial discipline and responsibility. Let me show you how this plays out in a scenario that seems completely backwards and counterintuitive until you understand the system's actual incentives and what it's really measuring. Let's say you decide to stop using credit cards altogether. You pay everything off completely. You close your accounts, or you just stop using them and let them sit at zero balance. You live debt-free from that point forward. You pay for everything in cash or with a debit card pulling directly from your checking account. You build up significant savings. You're financially stable in every meaningful way. You have an emergency fund. You're saving for retirement. You're spending less than you earn. You're doing everything that actually indicates financial health from a practical standpoint. Guess what happens to your credit score after a while? After months or years of this financially healthy behavior? It starts to drop. Not because you became irresponsible. Not because you started missing payments. You don't have any credit payments to miss. Not because you took on risky debt. You're not using debt at all. But because you're not generating new credit data. You're not active in the credit system. The scoring models are designed to favor recent, ongoing credit activity because that's what gives lenders current information about your behavior as a borrower. And here's the really wild part that most people don't know. Closed positive accounts in good standing typically remain on your credit report for up to 10 years after closure. After that time, they may fall off your report. If you're not actively using credit and generating new trade lines and payment history, your old credit history slowly disappears from your report over time. As your credit file becomes thinner with less history, your score can drop, even though you've done nothing wrong financially. Even though you're more financially stable than you've ever been in your life. Think about how absurd that is from a logical standpoint. Imagine if your doctor told you that your health score would drop unless you kept eating junk food once a month just to prove you could handle it and metabolize it correctly. Imagine if staying completely healthy through good diet and exercise actually hurt your health score because you weren't generating data about how you handle unhealthy inputs. That's essentially what the credit scoring system does. It can penalize financial health that doesn't involve ongoing borrowing and credit usage. So when someone proudly says, I have an 800 credit score, the real question isn't just how they got it or how responsibly they've managed credit. It's also, how much have they paid for it? How much interest have they paid over the years to maintain that score and keep it high? How much debt have they carried? How long have they been playing the game? What has maintaining that score actually cost them in real dollars? Because maintaining a high credit score often requires ongoing participation in a system that profits from your participation, and that participation isn't free. Let's talk about the silent punishments built into this system, because this is where the imbalance of power between you and the credit reporting system becomes really, really clear. Miss one payment by 30 days, even if you've been absolutely perfect for 5 years, even if you've never been late before in your entire life, and you can drop 60, 80, even 100 points depending on where your score started and what else is in your credit profile. One mistake, one missed payment because you were traveling internationally and forgot to set up autopay. Or because you changed bank accounts and the automatic payment didn't process correctly and you didn't notice. Or because you were dealing with a serious family emergency and paying bills just wasn't your top priority that month. One 30-day late payment can absolutely devastate your score for years. It stays on your report for 7 years. It affects your score most severely in the first couple years, but it continues to have an impact the entire time it's on your report. That's how sensitive the system is to your mistakes. One error, one moment of being human, and you're punished severely and for a very long time. Meanwhile, if there's an error on your report, a debt that isn't yours, an account you never opened, a payment marked late that you made on time, a collection from a debt buyer for something you already paid, a balance that shows higher than it actually is, and you try to dispute it and get it corrected, it can take months, sometimes years to fix. And during that entire time, that error is affecting your score and potentially costing you money. Here's how the dispute process typically works. You file a dispute with the credit bureau, either online or by mail. The bureau has 30 days under federal law to investigate your dispute. But investigate often means they send a simple form to the creditor or debt collector asking, "Is this information accurate?" The creditor or collector looks at their records, checks a box that says, "We believe this information is accurate," and sends it back. The bureau gets that response, sides with the creditor, and tells you, "We investigated your dispute and determined the information is accurate." You haven't actually gotten a real investigation. Nobody looked at your documentation. Nobody compared your evidence to theirs. Nobody made a meaningful determination. It's often an automated process that defaults to believing whoever reported the information originally. So you dispute again. You send more documentation. You escalate. You call. You send certified letters. You file complaints with the Consumer Financial Protection Bureau. And maybe, eventually, after months of effort, you get the error corrected. Maybe you don't. Maybe you give up because it's too exhausting and time-consuming and you have other things to deal with in your life. According to Consumer Financial Protection Bureau studies and reports, a significant portion of credit reports contain at least one error: wrong accounts, outdated debts, incorrect balances, accounts that should have been removed but weren't, collections that were paid but still show as unpaid. Sometimes even mistaken identities. Your information gets mixed up with someone else who has a similar name or social security number, and suddenly you're being held responsible for their debts on your report. Each one of those errors can raise your interest rates on everything you borrow. It can raise your insurance premiums in states where credit-based insurance scoring is allowed. It can affect employment opportunities in industries where credit reports are reviewed with your consent. It can prevent you from being approved for an apartment you want to rent. One person who watched one of these videos wrote in and shared their story. She lost nearly 100 points on her score after a debt buyer re-reported a collection for a medical debt she'd already paid 3 years earlier. The original creditor had been paid. She had documentation. But the debt was sold to a collection agency anyway, and that agency reported it to the bureaus as a new, unpaid collection. It took her 8 months and over 40 phone calls to different departments and agencies to get it corrected and removed from her report. 8 months. And during that entire time, 8 months of her life, she was paying higher interest rates on her car loan. Higher rates on her credit card because her score dropped and they did a routine account review and raised her APR. Higher rates on her car insurance because her state allows credit-based insurance scoring. She was denied for an apartment she applied for because the landlord saw the collection and rejected her application. Not because she was actually risky, not because she had done anything wrong, not because she was irresponsible with money, but because the system had an error, and fixing that error was entirely her burden to carry. The system had no structural incentive to care about the accuracy of her report or how much that error was costing her every single day it remained uncorrected. That's the fundamental imbalance. The system can punish you immediately and severely for your mistakes. But when the system makes mistakes about you, when it gets something wrong, when it reports inaccurate information, when it damages your score unfairly, fixing that is slow, difficult, bureaucratic, and entirely your responsibility to pursue. Pause for 30 seconds. Open your credit card app or banking app right now. Look at your highest balance card. What's your utilization on that card? What percentage of your limit are you using? Write that number in the comments. And drop your state too. Let's see the real picture. So how do you break out of the system without destroying your score in the process? How do you protect yourself and take back some measure of control while still navigating a financial world that requires you to have decent credit for basic things like renting an apartment or financing a car? Here's the practical framework that actually works. Step 1. Get your actual, full credit reports from all three bureaus. Not your score from an app. Not a monitoring services summary. Your full, detailed credit reports directly from Experian, Equifax, and TransUnion. Go to annualcreditreport.com. That's the only website that's actually free and mandated by federal law as the official source for free credit reports. Don't go to sites that sound similar. Don't use services that say free, but then try to upsell you on monitoring services. Go directly to annualcreditreport.com. You're entitled to one report from each of the three bureaus once per week now, which is a relatively recent change that happened during the pandemic and has continued. That means you can check each bureau's version of your report every week if you want to, though most people don't need to check that frequently. Download the reports, save them as PDFs. Actually read through them carefully. I know they're long and dense and boring, but read them. Look for anything that doesn't belong to you. Accounts you don't recognize, balances that are wrong, collections for debts you already paid or never owed in the first place, late payments marked on your report that you know you actually made on time, hard inquiries you didn't authorize because you didn't apply for credit. If you find errors, and statistically there's a decent chance you will, dispute them, but do it strategically. Don't rely only on the online dispute portals, because those disputes can sometimes be processed quickly without thorough human review. Send a formal dispute letter via certified mail with return receipt requested. That creates a paper trail that's much harder to ignore. In your letter, clearly explain what's wrong, why it's wrong, and what you want corrected. Include copies, not originals, of any documentation you have that supports your dispute. Proof of payment, account statements, correspondence with the creditor, anything that backs up your claim. The bureaus are required by federal law under the Fair Credit Reporting Act to investigate disputes within 30 days. If they come back and say, "We investigated and the information is accurate," but you know it's not, dispute again, escalate. File a complaint with the Consumer Financial Protection Bureau at consumerfinance.gov. Document everything. Don't give up just because the first dispute didn't work. These systems are bureaucratic, and they're designed to make you give up, but persistence often works. Step 2. Freeze your credit reports at all three bureaus. This is one of the single most powerful tools you have to protect yourself, and almost nobody uses it. Freezing your credit, also called a security freeze, doesn't hurt your score at all. It doesn't affect your existing accounts in any way. It's free by federal law. There's no cost to freeze or unfreeze your credit at any of the three bureaus. What a credit freeze does is prevent anyone, including you, from opening new credit accounts in your name without first unfreezing your report. If your credit is frozen and someone tries to apply for a credit card in your name, or tries to take out a loan using your information, or tries to open a utility account, the application gets automatically denied because the lender can't access your credit report to approve the application. That means if someone steals your identity, if they get your social security number and your personal information through a data breach or a lost wallet or any other means, they can't successfully use that information to open accounts and destroy your credit. They can try, but the applications will be rejected. And here's the important part. You can unfreeze temporarily whenever you actually need to apply for legitimate credit yourself. You want to apply for a new credit card because you found a good offer? Unfreeze your reports for a day or a week. You're applying for an apartment and the landlord needs to check your credit? Unfreeze it temporarily. You're financing a car? Unfreeze it for the loan application. You can do this online in minutes with each bureau. It's free. But the default state, the state your credit should be in when you're not actively applying for something, should be frozen, locked, protected. This is your data. This is information about your financial life. The bureaus collected it, yes, but it's about you. Act like you own it. Protect it the way you'd protect your social security number or your bank account login credentials. Step 3. Stop chasing micropoints and optimizing for tiny improvements that cost you money. If you're currently paying interest on purchases you don't actually need to make, or if you're keeping balances on cards you could easily pay off in full just to keep your utilization low or maintain activity on the account, stop doing that immediately. That's not building wealth. That's not smart credit management. That's feeding the algorithm at your own expense. Your credit score doesn't need perfection. It needs consistency and responsible behavior over time. Pay all your bills on time, every time. That's the single biggest factor. Keep your credit card utilization under 30% of your total available credit across all cards, and ideally under 10% if you can manage it without carrying balances you pay interest on. Don't close your oldest credit card accounts unless they have annual fees that you genuinely can't justify based on the benefits you get from the card. But beyond those basics, stop obsessing over tiny optimizations. Stop timing your payments to unusual days of the month to manipulate when balances get reported. Stop applying for new credit just to improve your credit mix. Stop keeping cards you don't want just because closing them might drop your score by a few points. A 780 and an 820 often get you the exact same interest rates at most lenders for most products. The difference between a 780 and an 820 matters much less in practical terms than the difference between your score and your actual financial stability. What matters more than your score is, do you have savings? Can you handle a $1,000 emergency without going into debt? Are you spending less than you earn? Do you have a plan for the future? Those questions determine your actual financial health far more than whether your FICO score is 780 or 820. Step 4. Build your 0-month fund while you're working on everything else. Because here's the real truth that the credit industry doesn't want you to fully understand. The biggest real threat to your credit score isn't a forgotten payment or a slightly high utilization ratio or a hard inquiry from applying for a card. The biggest threat to your score is living paycheck to paycheck with no buffer, no savings, no emergency fund. When you're living that close to the edge, one unexpected expense, one car repair, one medical bill, 1 week of reduced hours at work can force you to miss payments because you literally don't have the money. Or it forces you to max out your credit cards to cover the emergency, which tanks your utilization ratio and drops your score. Your 0-month fund, 1 full month of expenses in cash, sitting in a separate high-yield savings account that you don't touch except for genuine emergencies, protects your credit score better than any credit monitoring app or optimization strategy ever will. Because when something unexpected happens, and it always does eventually, you can handle it with cash instead of missing payments or maxing out cards. You pay for the car repair with money from your emergency fund. You cover the medical bill without putting it on a credit card. You survive the week of reduced hours without missing your rent payment or your car payment. Cash protects your score. Credit dependence threatens your score. Having a buffer means you're not one bad week away from financial disaster and a score drop. Build that fund while you're paying down debt if you have debt. Even if it's just $50 or $75 a month going into savings while you're aggressively paying down credit cards. Because that fund is what makes your escape from debt permanent rather than temporary. Step 5. Detach your identity and your self-worth from your number. This is the psychological work that matters most in the long run, and it's the work that nobody talks about because it's not tactical, it's not a strategy, it's not a hack. That 3-digit number between 300 and 850 doesn't define your worth as a human being. It doesn't measure your character, your work ethic, your intelligence, your potential, your value to the world, your deservingness of good things in life. It measures, in a very specific and limited and often flawed way, how profitably predictable you've been to lenders based on your past credit behavior. That's it. That's the only thing it measures. It's a business metric used by private companies to make lending decisions. When you understand that clearly, when you really internalize it and believe it, everything changes about how you relate to your score. You stop obsessing over 10-point swings that don't actually affect your rates or your options. You stop feeling shame when your score is lower than you want it to be or lower than someone else's. You stop feeling superior or morally better when your score is high. You start focusing on building actual financial security that exists outside of and independent from the credit system. Savings accounts, emergency funds, reduced debt, sustainable spending, investments, skills that increase your income, relationships and community that support you. You stop playing their game by their rules and start building actual stability on your own terms according to what actually matters for your life and your goals. Let's reframe what this number actually is at the most fundamental level, because the framing you use in your own mind changes everything about how you interact with the system. A credit score isn't a measure of trustworthiness. It's not a measure of responsibility or character or financial health or how good you are with money. It's a measure of how well you've played a game that was designed by private companies to serve the interests of lenders, not borrowers. The game is designed for you to participate continuously, to stay active, to remain a customer, to keep generating data and interest payments and fees over long periods of time. The game rewards consistency and predictability, yes, but it rewards those things because they're profitable for the system, not because they're optimal for you personally. When you start to see your score that way, as a metric of how profitable you've been to a system rather than as a judgment of your character or your worth, everything shifts in your perspective. You stop feeling shame about a number that dropped because of factors outside your control, or because of an error that wasn't your fault, or because you made one human mistake. You stop feeling superior because your number is higher than someone else's. You just participated in the system longer, or had more access to credit earlier in life, or made different trade-offs between paying interest and maintaining a high score. You start focusing on what actually matters for your real financial well-being. Do you have savings that can handle emergencies? Can you survive a month without income? Are you spending less than you earn consistently? Are you making progress toward your actual goals? Do you have options and flexibility and freedom in your life? Those questions matter infinitely more than any three-digit score will ever matter, because those questions measure actual financial security and actual freedom, not just creditworthiness and access to more debt. So comment your FICO range or your state below. Let's build a real picture of how this game looks, across different ages, different incomes, different cities, different life situations. And if you've ever successfully disputed an error on your report and got it removed, if you've ever fixed something that boosted your score significantly, tell that story in the comments. Someone scrolling through looking for answers might need that exact information more than you know. Someone might be in the exact situation you were in 2 years ago, and your comment might be what gives them hope or direction, or the specific tactic they need to fix their situation. Because the more transparent we all are about how this system actually works, the more we share real experiences and real numbers and real strategies, the less power the system has to control us through fear and confusion and deliberate complexity. You are not your score. You're the person who built it. And if it needs rebuilding because of past mistakes or circumstances or errors that weren't your fault, you can do that too. It's just a number in a system. It's just a metric calculated by an algorithm. It doesn't define you. It doesn't determine your future. It's just information that affects some of your options right now. Lenders and credit bureaus profit when you forget that distinction. when you blur the line between your score and your identity, when you internalize that number as a reflection of who you are rather than just as a tool in a system. So remember it. Remember that separation. Remember that you are a complete human being with value and potential, regardless of what any algorithm says about your past borrowing behavior. If this video made you look at your credit score differently, if it changed your perspective or gave you clarity or made you feel less alone or less ashamed or more aware of how the system works, hit subscribe and share it with one person you care about who checks their score more than they check their savings balance. Because the system only works when people stay scared and confused and isolated. Knowledge breaks that. Transparency breaks that. Community breaks that. And you just took the first step.